You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time to bring to a close our broadcast week here on the old Options Insider Radio Network with the funkiest tune and the funkiest show on our network this week in Futures Options. Like the name implies, this is indeed the program where we break down all of the amazing action in the other side of the fence, the futures options products. So your corns, your gold, your crude oils, maybe your soybeans, and maybe, who knows, maybe some surprise products thrown in there as well. Of course, we'll also hit up your questions and changes in volatility in these products and different evolutions and funky trades and all sorts of fun stuff. And of course, you can find all of the great past episodes of this program, as well as all the other fine programs on this network, in one fine place, the mothership, the flagship, the optionsinsider.com. While you're there, of course, click on a few articles and breaking news from the options market. All sorts of fun stuff popping off today, as indeed most days over there on the old website. Some breaking news, some articles, some analysis, unusual activity, education, all sorts of fun stuff. Even some futures info sprinkled in there as well, if you are so inclined. And of course, if you just want to mainline the audio straight into your ear holes, then of course iTunes, TuneIn, Google Play, iHeartRadio, pretty much all the major providers have our stuff. And if you just want to get the app, iTunes and Google Play and Amazon Fire for the Options Insider Radio Network mobile app, where you can get all of our programs. It's pretty cool, actually. You can build your own playlists. You can select stuff. And if you're going on a plane or somewhere where you don't have Wi-Fi or a signal, you can download the shows, too, so you can queue them up ahead of time. So it's cool, and you can listen. You can even listen at double speed if the sound of my voice is grating to you. We won't mind. It's all right. All right. And joining me on the old program today is my cohort, my partner in crime, freshly back from New York, as am I, talking all things metals in New York, but we're back here to talk all things futures options. He is Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here quite a bit called Quick Strike. Nick, welcome back to the TWIFO program, sir.
Hey, Mark, I could tell I'm a little bit worn out from the trip because I was bobbing my head to the funky music, but I was in between the beats and not on the beat, so I knew something was wrong. So hopefully I can get on the beat.
Got to get on the beat for the rest of the show, sir.
Yes, sir.
But it was a fun week. Actually, seemed like a week. It was only a couple of days. You and I just headed over to the Big Apple because it was Metals Week over there, which was kind of interesting. No big conference, really, but a bunch of events around metals aimed at the metals market. You and I went to the CME Metals dinner a couple of days ago. Actually, yeah, a couple of nights ago over there now in New York. And I think you and I were both surprised, Nick. I won't speak for you, but I had no idea the New York metals community was so hot, so big, so active. Maybe that's more a sign of kind of how hot gold has become in recent months. Was that your take as well, or were you just surprised by the size of the crowd at the event?
I think well, you and I both sort of commented to each other at the same time when we walked in that there was a lot of people there, and there was a lot of institutions present, a lot of FCMs, a lot of people trading as well. So I think it was a bit surprising that there were that many people. But you know what? It's a big market, lots of stuff going on. You know, I know that they had a big announcement to make. It didn't seem like the announcement got reverberated too much, but it was a good event. You know, ran into a lot of people that we didn't think we'd see, right? So it was worthwhile. You know, so not too bad.
Yeah, fun events. And if you want to hear our breakdown of that, Nick actually joined me on our LSFO program, the long and short of futures options program that we record with our friends over there at CME to talk a deep dive into all things precious metals over there, as well as some new products that they're kicking off over there fairly soon, actually, hoping a late October, including some cool. We talked about the gold-silver spread on this program a couple weeks ago, Nick, and they're going to launch a gold-silver spread contract aimed directly at that market. So some pretty cool stuff. Keep an eye out on the network for the long and short of futures option. Should go live early next week, and you can check it out for yourself. Since we're talking metals, Nick, let's just start there because we were kind of engrossed in all things metals, particularly gold, this week, so we'll pretty much talk gold. Silver has kind of cooled off, and actually, interestingly enough, as hot as the conference was, as hot as people seem to be interested in gold this week, there wasn't a heck of a lot lighting it up this week from an overall gold perspective. And the futures were off, don't get me wrong, they're off about 20-odd handles, which is a decent move out there, and we kind of speculated about some of the drivers of that again on the LSFO, so stay tuned for that. But overall, vol has kind of certainly compared to what we've seen recently, vol has kind of tapered off out there somewhat. As of this morning, it was hovering right around near, the 30-day vol was about right around near the bottom or close to the 52-week range out there. The implied vol hovering about a 15% out there in 30-day, depending on where you're looking. A little bit more, obviously, as you go a little bit farther out. But still, not a lot going on about in gold, which is kind of interesting given the heat that's been up there, just in the interest on this product category. Again, the sheer volume of people there who were willing to shell out a fair amount of money for each ticket last night or 2 nights ago, Nick, kind of shows you that perhaps gold and these other related products, silver, but indeed they're also going to do a gold platinum product as well out there. So a lot of people are perhaps interested in the shiny stuff. Any thoughts? Obviously, it wasn't the most active week out there for gold. Overall, open interest decent, up about 3% this week in terms of the big gold products. And the strike leading the charge this week was the SEP. The SEP looks like, the SEP 1300 puts with about 4,600 of those contracts lighting it up this week. Aside from that, Nick, anything catching your eye, either in gold or maybe some of the other precious metals that they're launching new products on over there?
Well, there's a couple things I want to talk about. One of them's kind of funny, I think. First off, I just tweeted a gold-silver ratio chart. Mark, as you recall, you and I started talking about this a couple weeks ago before we ever heard anything about the new ratio future that was coming out. So it's going to be a gold-silver ratio, so gold over silver, and that thing trades over the last, 5 years. It's traded anywhere from as low as 36 to as high as 80, 83, 84. So right now it's in the 70 range. So I put out a chart there. It's got 30, 60, and 90-day moving average. And just for the record, we'll be putting out some volatility numbers against that ratio as well, so people can start to get an idea and take a look and see how active that is. The other two, gold, platinum, and platinum, palladium, those are spreads. Since those numbers are more evenly matched from a magnitude standpoint, those are going to come off as spreads. So I thought that was a little strange that there would be ratios and then spreads, because we were talking about a ratio. It just seems like easier to track, but I guess it makes sense from the industry when we heard Miguel Vies talking about how that spread has been, gold, platinum has been trading for a long time, and it's been pretty volatile. The other interesting tidbit from the event, Mark, as we're sort of laughing about it, is that the old Dec-Feb gold spread trade, right?
Yes, everyone's favorite.
That was my favorite, because we were all talking at the table about what everybody sort of did and why they were there, and I sat next to a guy, and he traded metals, but he traded specifically the Dec-Feb spread. So
that's like saying I only trade the 105 calls I trade the Jan 105 calls in Apple, and that's it. And then I sit on my hands the rest of the year.
I know you and I, and I love it, because we both know guys that traded the spreads, right? And that's what happens. That they focus on the spreads, but it just cracked me up when it was the Dec-Feb spread. I just couldn't get enough of that after. So I've been telling that story to everybody. Anyway, as far as what's going on out there, more of the same, like we talked about last week. Vol's up a little bit, skews kind of flattened out even more than it was. So basically, we have a pretty much an even smile in the vol curves across the board. So again, that's something to take a look at. We're basically trading in a range like we've been talking about for a while, and vol is trending to it's a little higher. I'll call it flat. Basically, when you're talking about 0.25%, that's essentially flat as far as I'm concerned. You got to have some big Vega numbers to have any effect on premium there. So we're seeing rangy sideways trading in the gold, with the vol curve coming into sort of a regular even smile, which basically says people are waiting for an event to take place before any big decisions are made. And if we look at we look at the skew, but let's look at the quick skew. And the quick skew is basically saying, it's a smile. I mean, the calls are a little bit. The calls and the puts are both more expensive than the at the money, obviously, and they're pretty much evenly expensive to the at the money. So, or with the calls being a little bit more expensive than the put. So, still a little bit of a bias that way. Just the regular 25 delta call minus put, that's kind of flat. So, we're seeing that it's in a range. It's in a trading range. Not many people have a decisive action in place in terms of which direction they think they're going to go. Therefore, we're seeing that spread pretty even. And then as far as the trading goes from the put call ratio, the volume standpoint, calls were a little bit of a leader this week, but not by much. And we're still seeing, as a general open interest put call ratio, there's still calls biased over puts. So probably more than likely still upside bias, especially since we're, kind of in the lower part of a range. But I think the most interesting part of the gold for me this week was the Dec-Feb gold spread. That's I'm going to stick with that one.
That's our crazy trade of the week right there, sir. I'm not sure how active it is right now, but Dec-Feb gold is clearly where the action is. At least at that dinner last night, everyone, or at least a handful of people, loving themselves some Dec-Feb gold. All right, let's move on to a product that had a little bit more action this week. This is, of course, the sticky stuff, the Texas tea, black tar, call it what you will. It is, of course, WTI, all things crude. A fairly light net week from an underlying movement perspective. Futures off about 2.5, 2 handles, depending on where you're looking out there. So net, not the most close to close, not the most exciting of weeks in terms of net movement, though we did have a little bit of volatility and movement in between there. As we were talking about vol out there in crude land, we saw a spike, about a little less than a week ago or so out there. A lot of the VIXs that track a variety of different crude products, including USO and WTI, they've both been kind of at the lower end of their range for some time. And over just about the last week or so, we saw them both spike from about the mid-30 range up until about 46 or so, and then it kind of came off that, hovering around the 40 level right now. So still mildly elevated off their lower end of their range, but of course, when you look historically back over the last 6 months to a year on those products and the spikes they saw into the 80s back in the February timeframe when things were really going crazy, they're still vol is still pretty cheap out there. As we expect, we'll continue to see vol creep up if we do continue to drift down in the big crude, because the puts are still maintaining that premium to the calls out there from a volatility skew perspective. If we continue to rally out there in WTI, unless people start bidding up these calls like crazy, we're probably going to see vol continue to come off. So that will be dictating, at least for a little while going forward, how this vol plays out. Looking at where people were playing this week, we saw the puts, surprise, lighten it up again this week to lead the charge. It is this interesting dance out there, Nick, between near out-of-the-money calls and near out-of-the-money puts. We're hovering right around 44, 45 in the futures out there in WTI, so we're seeing a lot of interest in the 40 strike on the puts and a lot of interest in the 50 strike on the calls, and that kind of reflects somewhat the push and pull that's going on out there in the contract itself. The bulls and the bears are fighting it out. Some thinking the 50 handle is coming soon, some thinking the 40 handle is coming soon. This week, the 40 handlers are winning it out with about 22,000 of the D's 40 puts lighting it up, including a big chunk going up on Tuesday, about 8,000 of those bad boys, another 6,500 or so going up today as well. So it wasn't even paper in that contract. It was kind of two big chunks accounting for over half of that paper. And then we have also the Nova 40 puts with about 18,500 contracts. That one was fairly evenly distributed throughout the week, so there was no large spurt of trading that really drove a lot of that volume. Same for the Nova 50s. Again, when you get into Nova, it was fairly even, upside and downside, kind of lighting it up close to similar amounts, about 16,500 or so on the Nova 50 call side. Again, also evenly distributed throughout the week, so it wasn't like there was one spurt of activity that lit it up on all of these strikes. We are seeing, as I said, vol has over time has crept up a little bit, even though it is a little bit off recently. But still, net on the week, we saw at the money vol creeping up a little bit, about a point or so out there across, depending on where you're looking on the term structure. Obviously, getting a little bit more as you go a little bit farther out on there. And overall open interest up about 6%. So again, another fairly active week. This is kind of been quite a while, Nick. I can't remember the last time we saw an open interest decrease out there in WTI. So this product continues to really kind of grow and light it up week over week. There's, we were joking on the last episode that there's always, we joke, there's so many Fed governors, but there's always someone out there who can pontificate at length about all things WTI and crude. It could be a Saudi prince, it could be a Russian oil minister, it could be someone here domestically or at a big producer. It doesn't. There's no shortage of people who can drive crude, just like there are the Fed governors who drive the will they, won't they Fed dance. So there seems like there's no shortage of headlines, and as a result, no shortage of increases in open interest and volume and interest. Again, as is kind of par for the course for WTI, the lion's share of the volume, almost 2/3, was in that front month November contract there. People don't want to play far out here, Nick, which is kind of interesting. We have a listener question that kind of involves that maybe a little bit later, so maybe we'll save the longer term talk for then. But what caught your eye? Interesting stuff. I know you like looking at some of these the max OI strikes out here. I think Max Payne, call it what you will, on some of these strikes, as well as some other interesting things. So what's been catching your eye out here in WTI this week, Nick? Since aside from you and I gallivanting all over New York the last couple of days.
Let's see what we got. So you mentioned most of the volume stuff and put call ratios. Basically, again, we try to look at those on a regular basis just to give the audience an idea, of where the majority of the trades happening from a volume standpoint. So pretty flat there, a little bit over one, and more put than calls in the December contract. But overall, as a product, pretty flat with a little bias to the puts. The bigger strike from an open interest standpoint, open interest change standpoint, this one is kind of interesting, is the 50.5 call. So we're going just outside the max strikes that we were talking about with the 40 and the 50 strike. So majority of the volume, 75% of the volume of that 50.5 call was an opening position. So about 4,000 opened there. We did mention the max. You mentioned the max OI. So still, if you put the the November and the December together, the max OI strikes are the 40 and 50. In the December, it goes out a little wider to the 30 and the 60, but reality is the next highest strikes coming in are the 40 and the 50. So that range is pretty well established, and that'll really be interesting to see the perspective of our special guest, and we won't say who it is yet because our special guest for next week, who's an oil guru, it'll be interesting to see what they have to say about what we've been talking about with the open interest. So, but right now that seems to be the range that's trading, and market's off, and it's basically off about twice as much as it was up last week. Vol's pretty flat. And what I really wanted to talk about too a little bit, and I'm gonna push this out right now. I'm gonna push out a quick skew chart. I'm tweeting it right now. If anybody's out there, the calls have been cheap to the puts for a while, and as we continue to trade in this range, it just seems like the market's been they've been trying to push it down, but it seems like a majority. If the traders and the OPEC people and the producers and stuff, there's obviously the desire for it to go up, and everything's been trying to push it down, but it hasn't really pushed it down that much. And we've kind of bounced around this 43 to 44, just below 44 range. So I feel like given that and seeing how it's traded and seeing it hasn't been able to get too much lower or get down to that 40 handle in a while, or below that 40 when we saw it that one day where it went down there. Just feels like now might be the time to take a look at that quick skew chart, or take a look at the fact that the calls are trading below volatility to the same delta puts. In December, it happens to be that the 40 strike and the 50 strike are basically the 25 delta. So when we're talking about our risk reversals here, we're essentially talking about the 40-50 risk reversal, or the collar, however you want to call it. And the 40 puts trading like 6 vol points above the 50 strike. So as part, I think, Mark, I put it out there, and you could put it in the show notes because I put the link in there. So I built a trade where I bought the at-the-money puts and sold. I bought the 45 puts and sold 240 puts, and sold the 45 call and bought 250 calls. So basically what's that doing is I got 50 deltas long on the 50 calls and 50 deltas long on the short 40 puts, and 100 deltas short on the synthetic future by selling the put and buying the call on the at the money. So basically putting on like a double collar hedged with the synthetic at the money. So you are getting long cheap vol and short expensive vol. And that trade from a break even standpoint, it looks just like like a triangle up and a triangle down, but there's also that opportunity to, if you get a little reverting back to the mean for these call and put volatilities, some money to be made that way too. So I thought that might be something that people were interested in looking at. And that link is live, by the way. So if you click on that link, you'll be able to track it. We put it on essentially for flat, like 0.12, which is $120, but I should have just made it 0 so it was flat, because that's probably the safer way to think about it. But maybe it's worth taking a look at and watching over the weeks to see if there's anything good that comes of that trade, because it just feels like, given the way it's trading, and the vol's been cheap on the upside for a while, and the vol's been expensive on the downside, and we can't seem to push down past these levels the last couple of weeks, that might be something to look at from a trade standpoint.
Yeah, we've seen that a few times here, that just this endless premium to the puts out here, the endless seeming discount to the calls. It certainly does seem to warrant at least looking at some of these bullish risk reversals and these things I've been setting up. You got it on a bit of a funky ratio there, which is kind of interesting kicker to that. So if you do get that nice upside run, then you get a decent run there. But that's definitely an interesting setup. Certainly more favorable than the other way of going perhaps along the future and then trying to hedge by buying the put with the collar and selling the call. That's not going to work out too well, just because it's already set up that way. The price is already built in. You want to kind of lean the other way and perhaps use that bullish risk reversal to, aka not really short collar. I don't like that use case, but some people like to throw that out there and use that as a way to get your exposure to crude. And if crude drops below the level you've identified there that you like out there in WTI, you end up owning some, but probably at a fairly attractive level. And if it rallies, well, then rally ho, you get to rally with it. So it's not a bad little setup. And of course, you get all the nice commensurate leverage and margin benefits from going out on the options there. Nick, I've been toying around with. We talked gold, we talked WTI. I don't know. You've been looking at You've been looking at beans over the past week. Beans is kind of like the other product that keeps popping up here on our radar ever so slightly. It hasn't really been as active as it was earlier in the year, in that May, kind of June, July timeframe. We really saw soybeans just taking it up to another level. Limit moves seemingly daily or close to it. The puts were cheap, the calls were bid. So if you did want to go collars out there, that was the place to do it. As we've said on the show now, not so much going on out there from a collar perspective. Those setups are nowhere near as favorable. You can't buy the cheap puts and sell the rich calls and do it against your future and be a happy camper all day long. It's now nowhere near as rich. That trade is kind of off. And looking at what's lighting it up out there in soybeans, yet again, this is kind of the story for soybeans. A Nove is where the lion's share of the volume was, a little over half this week, so not quite as Nove heavy. Again, that has to do with the crop cycle out there in soybeans. So these ag products, they dance to the beat of a little bit different drummer than some of the other products we talk about, and that kind of tends to dictate how their paper flow works out. But I know, Nick, you said you were keeping an eye on all things soybeans this week. So what was catching your eye out there in the green stuff this week?
Well, if we take a look just sort of quickly at what we're seeing here is, we were off early in the week quite a bit, and then we got a little bit of a retracement today. So it looks like it's, again, what's fun with the This Week in Options report or the This Week in Futures Options report is that, you see the result of the week, but, you really need to sort of click into the things and take a look and see how it started and how it ended and, where the advancement was and where the retracement was. So again, I see a lot of red on the left side of the report. Futures down, vols down, skews down. So again, we have another product here where we're basically getting back into the regular smile pattern again. We're seeing, let me take a look a little bit more closely at the November contract. We're seeing, we're basically almost everything is sort of, the 25 deltas are almost even with the at the money from a volatility standpoint, and maybe a little bit bid. So we got a pretty flat looking vol curve, a pretty flat skew. Vol is off, although vol is not near the lows that we saw this year, but it's still been trending downwardly. It's been trending downward significantly. So you kind of missed the boat if you were selling vol and beans because the high happened a little while ago. But there is still that bias going down, and it can go lower based on what we've seen in the past. Still kind of continued range trading here. So you're seeing spikes up and spikes down. And the good thing there, I guess, is that, Mark, we've been talking about, the bean movement's been paying the rent, right? So there's been enough movement to cover owning that volatility or owning those gamma options. So you should be able to scalp enough return by when you own those options, given the amount of movement that you're getting in that underlying. So, even though it could get cheaper, you still could get some benefit by owning some options here, either maybe some cheap calls or some cheap puts where you hedge the put, buy some puts, hedge them, let the market rally up on you, get out of those futures and hope it goes back down again so you could re-hedge them. So basically you're just scalping gamma. So you get in these low vol environments, a couple things happen in a low vol. Vol can go lower, right? So you can lose some money there. But if the underlying's actually moving like it is here, excuse me, because we're in a range, there is some opportunity of back and forth here. So you can get some options. You can be delta neutral. You could probably, I don't know the nuance of it, but you could probably save on some margin. And you hope you get this sort of back and forth in the underlying, and you have a way to trade futures and being covered from a margin standpoint because you got some options on. So that seems to be sort of the interesting stuff for me in the beans right now, is that there's a decent range. The movement's covering the volatility. The implied volatility is sort of even with the realized volatility, and for a while it was much higher than the realized vol. So, stuff is there. It may seem like sort of a dismal or dreary market, but when you start to look at it that way, it seems like there might be some opportunity there.
Well said, sir. All right, and that's going to do it for our initial segment, but I want to make sure you guys get some love on the show too. So without further ado, let's keep on rolling into our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome back to the program. Of course, we're in the Futures Options Feedback. This is the part of the show where you get to dictate what the heck we talk about. And I like that. It's always fun to see the directions you take us. The man told you how to hit us up, so I won't hit that again. If you are streaming live as well, you can always hit us up via Mixlr as well and get live questions on the show. But we got a bunch of ones you guys have already sent in to hit to. Let's see how many we can get to today, Nick. Let's start off with an easy one here. This comes from JVay83. He or perhaps she writing, "Hey, got a rookie question alert." Well, we don't mind those. We take all types of questions here. They go on to write, do the same Greeks apply to equity options and futures options? Are all Greeks the same? I like this question, Nick. It kind of implies this separate category, the separate classification of Greeks for the futures options. You know, it's the futures options delta versus the equity options delta. No, of course, I'm joking. Greeks are the same pretty much across the board, particularly for those core Greeks, your delta, gamma, theta, and vega that everyone always talks about and utilizes. You know, you start getting into some of the funkier, more esoteric applications of Greeks and some of the funkier Greeks known as the second order Greeks that are kind of your rates of change of your various other Greeks. Then you start to get into some nuanced use cases, and there are some specialized applications there, but that's far down the road. We don't need to get to that right now. In terms of your standard delta, gamma, theta, and vega, your delta of a futures option is the delta of an equity option. Your gamma is going to be your rate of change of the delta, same as that. Your time decay is going to be your time decay. Your vega is going to be your vega, and these are all things. That's the nice thing about options. You know, people get confused about the terminology sometimes, some of the minutia of the contracts. But if you learn some of these basic concepts, you know, a vertical is a vertical. Doesn't matter what product you're looking at. Delta is delta. And so that's kind of nice. Some of these constants, they remain the same throughout the different products you're looking at. And it gives you a nice core. So once you understand and mastered these concepts, you can apply them. You can go from trading, let's say, Facebook options to trading a WTI or a gold, something like that. And you still have to understand some of the nuances of the underlying, of course, and like things like the volatility skew, like we mentioned here all the time on the show. But the core concepts, the core tenets remain the same. And that's a nice thing to have in your back pocket when you're learning about these products for the first time. Mr. Nick, anything you want to add here for our friend JV, who's worried that he's missing out on those special futures options Greeks that everyone loves so much?
No, I think the only thing that really comes to mind is the old saying, "It's all Greek to me," right? So if it's all Greek to me, then it's all the same, right? So the only thing I would warn is, depending on what platform you're using or reviewing, you want to make sure that you understand the units that each of the Greeks are presented on the screen. So sometimes people will present them in ticks, sometimes they'll be presented in dollars. So you just want to make sure that you do a few examples for yourself before you make any snap decisions using those Greeks. So always know what your units are, and then that will help you out. But yes, they're all the same. You know, we toyed a little bit about putting some of the third order stuff in there, and I read a lot about it to see if there would be anything useful or if people would use it. But there are people that trade it and use it and sort of use it as an aggregate to see how their portfolio might react. So if we get to the point of putting some of those next order derivatives in there, I'll be sure to mention it on one of the shows going forward.
Oh, there we go. A funky addition to Quick Strike, the second order Greeks for all the hardcore out there. There are obviously some of those that are very useful. You may even follow those listeners without even really knowing about it. Some of the ones that measure, let's say, your rate of change of your skew, for example. That's obviously a very, very popular and important one. And you may look at that without even knowing that was indeed a second order Greek. So there are a lot of different use cases, but at the end of the day, they're the same. And your point is good about the nuances, the contract specs for the underlying. That's where the futures options options are really going to trip you up because all the products are all different. We talk about so many different products this week, some of the same ones. But as you get into more esoteric products, the sizes, the ticks, all the different things, that can really trip you up more than the basic delta, gamma, theta, vega stuff. All right, let's see another one here, a little bit longer, but actually a longer term question too. This one comes from Eric Schaeffer. He writes, I traditionally trade leaps on indices and individual names like Apple. If you don't know what a leap is, listener, it stands for long-term equity anticipation security, aka longer-term options, usually a year or so out on the time frame and beyond. He goes on to write, your shows, including TWIFO and LSFO, have intrigued me to dip my toes into the commodities markets. Well, I'm glad we could lure you to the dark side, Eric. He goes on to write, I've played around with the TWIO report on CME. So there you go, Nick. He's using the report there. Thank you very much for all that free data. Well, you're welcome. I'm exploring longer-term options on a variety of products, but I'm having difficulty finding the right duration. I know there are weekly futures options, but do they also have the equivalent of leaps? If so, how far out do they trade? And what are they called? Is there a tab for them on the TWIO report? So a bunch of interesting questions here to tackle. Let's start them off. I'll let you handle the stuff about the reports and things because obviously that's your baby. I'm looking here right now. You can obviously play with some of these expirations. I'm pulling it up right now just in the quick strike. I'm in WTI, so I'm going to pull it up there. Listeners, you can follow along with whatever product it is you're interested in. Obviously, there's the weeklies in there, and they have Jan and Dec all the way out through. Actually, as I'm looking here, it looks like WTI goes out through Dec of 2020. Which is extremely long time out. And as you might imagine, that makes sense. There's a lot of the producers and people on the institutional side of crude who don't want to play in the here and now right now. They want to play 2, 3, 4 months down the road, or 2 years, I should say, because they have to sell their future production and everything else like that. So there is a very strong interest in a lot of long-term activity as exhibited here by WTI. You can go all the way out to Dec of 2020, and if you wanted to go beyond that, I'm sure there would be an OTC house that would oblige you if you had enough size and your account was big enough. But that said, it raises an interesting point, Nick, which I hadn't actually thought about till I saw this question. The leaps obviously have a name on the equity side of the fence. They're called leaps. There is no concurrent term for a long-term futures option, at least not that I'm aware of. Do you know of one?
Yeah, I think they call them illiquid options. So
look at you throwing out the nuggets, the little jokes here on the show. You're all jet lagged and you're still throwing out the witticisms.
Yeah, I think that's what's doing it. No, I actually the energy markets go out 10 years. There's 10 years worth of options. So there's 12 times 10, 120 options. In Quick Strike, we only go out like 3.5 years at a time because of the lack of liquidity that's out there. So like you said, you will see some institutions or some funds or whatever trade strips. So they'll say, give me the December strip for an extended number of years, or they'll say, give me the annual strip for this many years, or the quarterly strip. So the only thing I would say about that is that to be really careful on those longer termed options, just because we had a good conversation actually about long-term options in the equities when we talked to the Swan guys, right? I learned a lot that week, and I think if you are interested, maybe you should go take a look on the site and listen to that one, because that'll give you some good insight into the leaps, at least from the equity standpoint. But as far as the futures go, I don't know how much benefit there is. I know that when we were trading that stuff, the longer you really didn't want to, because the premiums were so high and you had to sit on them for such a long time. I don't even know what the margin is on that stuff, to be honest with you. So I wouldn't leap too far into the expiration bin, and the reason you're going to stay a little bit closer is because of that ability to have some very good liquidity in the shorter dated stuff. There's plenty to do in the short dated stuff, so I don't know how far out I would go.
Look at you with all the jokes here on the show today. But yeah, you're right. They are somewhat illiquid. This is going to be with all these leaps are the same thing. Most leaps are not the most liquid of contracts. And they have some use cases, as Nick mentioned, one of the Swan guys on our advisors option program. They tend to lean towards the leaps to defray some of that time decay that you pay in the nearer portion of the curve if you buy a put let's say 6 months out and closer, maybe even the 3 months out range, you're going to pay a lot of decay in that. Versus a couple of years out, the decay as a percentage is not going to happen as much. But then you have other issues with that. As Mick mentioned, the cost of carry getting out all that far gets very pricey for the amount of protection, the strike you're looking at getting versus the decay. I kind of wonder at some point where that trade-off lies. And again, that's a good conversation to have because it's an interesting topic, and everyone has a different outlook on that. But I've never been entirely sold on the efficacy of buying, let's say, long-term protection, because then all of a sudden, when it hits the fan, as you know, the farther out you go, more vega, but also your delta tends to, if you're out of the money, tends to decrease. And so you're getting less bang for your buck, less protection for that put that you're spending so much money to get. So there's a bit of a question mark about the efficacy of that on the long term. But there are some ways you can play with that. I know the guys at Swan do that with some strangles and other things they do to try to offset that. Some interesting things you can do, and there are interesting things you can do on the futures option side as well. So yeah, long story short, they don't have a name, Eric. They don't have a fancy. Maybe we should come up with it. I like your illiquid options suggestion. maybe we'll start using that. I want to trade those illiquid options. But yeah, I like. There's no fancy name for them yet. We'll have to coin it here, Eric. But good question. They do trade, depending on the product, they do trade pretty far out, as Nick mentioned. Some of the energy is going all the way out beyond some 2020. And do they have leaps? So yeah, they have them. They different names, no names. And is there a tab for them? Yeah. What you do, actually, Nick forgot to mention this, but I'll do it for him. If you want to find these types of things, there's no tab that says leaps or the equivalent, obviously, on it. But you click on the expirations tab there at the top. And then you'll see a bunch of different segments. You'll see the weeklies come up. You can choose whatever expiration cycle you like. If you're into Jan through Dec 2020, you can have at it or whatever it is that floats your boat. So that's how you change the expirations there. You guys can do that yourselves as well over there on cmegroup.com/TWIO. All right, listeners, that funkatoon, that funkitron, call it what you will, means it's time to bring to a close this funkiest of programs here, and indeed our broadcast week here on the old Options Insider Radio Network. I apologize, it was a little bit truncated this week in terms of our broadcast week, but we had to go to New York and do some business there, so no live stream of OB yesterday, but you'll get all the shows back next week, don't worry. And before we go, Mr. Nick, we're talking leaps here, we're talking all sorts of other things, liquid and illiquid. We were talking weeklies earlier on the show. What else you guys cooking up over there in the realm of all things quick strike?
All right, well, good. Well, I could finally say that this weekend we'll release on the CME Group website the open interest heat map, and I think people are going to like that. That's going to go live on Monday, I believe. So there you'll be able to look at highs and lows very easily within an expiration, within a call or a put, or across an entire matrix. So take a good look at that. And then as far as other stuff going on, I just would, if you haven't tried it yet, or if you haven't gone out there and registered for Quick Strike Essentials, I think it's probably a good time to do that. We've all these free tools that we are putting on the CME site. Those are all integrated into the Quick Strike Essentials as one tool set. And we also have just released a nice cross correlation tool out there, so you can see 1 year's worth of correlation between 17 or 18 benchmark products. So some good stuff. So take a look, and we haven't got a great deal of feedback, but from the Essentials community. But if you guys go out there and you register and you take a look, give us some feedback, good, bad, or indifferent. And we always try to address the needs of our users and to get new stuff out there, or at least point you in a direction where you can get it. But go out there, take a look, cmegroup.com/quickstrike, QUIKSTRIKE. And finally, don't forget the Dec-Feb gold spread. That's the last thing I got to say.
That's going to be the title of our episode. That or illiquid options. I don't know. The Dec-Feb gold spread. I like it. And on behalf of Mr. Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. Of course, don't forget to join us every week via Mixlr, MIXLR. And don't forget also, head on over to cmegroup.com/TWIO, and you could generate all these reports we're talking about. You guys can do it all yourself. You don't have to listen to us. Well, you do have to listen to us, but you don't have to just rely on our show to do it. You can always do it all throughout the week. The numbers are constantly rolling, so you get a constant rolling total for the week. The previous 7 days, you get a nice little adjusted total there, which is nice for you. Check it out, cmegroup.com/TWIO. And we'll see you next time right here on This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.